Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, April 22nd, 2016. First, I want to say that if you have any questions or any comments about the videos or the blog posts, please don't hesitate, send them in. I'd love to hear your opinions, etc. So please send your questions and comments when you get a chance. This week we'll look at S&P 500 ETF SPY, which did make an all-time high. This includes dividends. The breadth did improve somewhat further, but divergences still abound in the various indices. Now we'll look at correction targets for the S&P 500 if it rolls over now. Also, sell in May and go away, whether or not this is true. Bonds are under pressure, while the AGG, the Diversified Bond Fund, closed close to all-time high. Look at the dollar. It held support the second time in as many weeks, and we'll look at the US dollar versus Japanese yen, and it could be a bear trap there. Gold is ready to correct, and we'll look at GDX with an outside reversal on it. Also long-term oil picture in oil and natural gas that did take out resistance level. Quite a bit of topics this week. Alright, I have quite a bit of charts, as you can see from the top here, so I'm gonna go through them relatively quickly. So this is an all-time high for the S&P 500 ETF SPY, and the reason is because this data includes dividends, and the S&P 500 ETF SPY provides about 2% of dividends, so this makes sense because the dividends are added back into the price. Now, so technically we did close above all-time highs, so the bulls probably think that this is a good thing, and I actually kind of agree with them. Now, this candle here looks like quite a steep sell-off, and then continued on Thursday and Wednesday. We had more continuation lower, but on Friday rather we managed to close basically flat. For the week, S&P 500 S&P gained about half a percentage point. But you know, again, my general outlook on this market is still somewhat bearish. I'll try to prove why. And some of the reasons are below here, and that's market breadth. So we have several indicators here. We have the advanced decline line and advanced decline volume line. So advanced decline line did indeed break out to new all-time highs. In fact, it broke out in mid-March, so that's certainly a good sign. Now the volume is lacking. You can see that whereas the advanced decline line is already at new highs, the volume is still below, so you can see here. But even more importantly, I think, is the divergence in the indicators, and this is a intermediate term breadth momentum oscillator. It is basically an oscillator of the advanced decline line, and you can see that it made a lower high, and this is a divergence, whereas the index itself made a steeply higher high. So divergences like this, you know, it's something that you don't want to see, especially at all-time highs. So certainly this is an oscillator. Certainly it's time for it to possibly go back into the negative territory. So that's one of the many divergences that I'm about to show on the various charts. Okay, this is S&P 500, the actual underlying index, and you can see that we have not made an all-time high without dividends. This is my proprietary market breadth index that showed that we entered the bear market back in September of last year. So this rally was a bear market rally, and actually my subscribers, we did short it several times here, and we rode all of this down and made some nice money here. Now, as far as the divergences, you can see here pretty clear actually. The index is pushing higher. Even momentum indicator like RSI made a lower high so far. We have several of the breadth indicators, the percentage of stocks above the 20 and the 50-day moving average, exponential moving averages, looking like they're making lower highs. Now, we did have some improvement in, for example, percentage of stocks above the 200-day moving average. So that's certainly a positive sign for the S&P 500. Also another divergence you can see here for the bullish percent index. We can make it slightly lower low. So again, this is quite a bit of divergences going on here for the S&P 500. Next, moving on to QQQ. Big drop, big gap here, and several of the big names like Google missed earnings, rather the reaction of the market to the earnings was quite negative here. We had a big gap down here on Friday. But even before that, we had a bearish divergence. You can see here that it started back in March. This is again a breadth momentum oscillator for the QQQ. You can see it's making lower highs while the index itself is making a higher high. So again, another divergence here. Another longer term chart of QQQ. Again, divergence on the RSI and the percentage of stocks above the 20-day exponential moving average as well. You can see it's trending lower while the stock index itself is trending higher. And the same thing goes for bullish percent index for the QQQ, the same thing. You can see it was trending lower. Another set of divergences on the New York Stock Exchange Composite Index. Here back in October of last year, you can see that there was a divergence. You can see that New York Stock Exchange Composite made a higher high, while the breadth momentum oscillator actually made a lower high. So that was a like a good tell. And sometimes those divergences really work out really well, and you can see that we had a big drop afterwards. So right now we have something similar. We have index actually made a very steep higher high here, but you can see clear divergence here on the indicator itself. Again, same thing here for the percentage of stocks above the 20-day EMA. I have to tell that, I have to give credit where the credit is due, and you can see that there was a significant improvement in the bullish percent index and percentage of stocks above the 200-day exponential moving average. So certainly there is improvement in the breadth. However, again, we could easily correct down, especially now that we have those divergences in the breadth momentum and other momentum indicators present. And this again is a long-term chart of S&P 500 going back to 1996. In the upper part here is the market breadth index, which basically calls for whether or not the S&P 500, and this works for S&P 500 pretty much, whether or not it is in a bull or a bear market. And also it eliminates quite a bit of whipsaws that are marked here by the pink boxes here. So for example, here in 2011 we had pretty significant dip, but really market breadth index did not call for a bear market, so this would have been kind of continuation of the bull market from 2009. Now currently this is a proprietary index that I created. This MBI is calling a bear market still. So this could change at any time. In fact, I'm following some of the inputs that go into the creation of this index, and there's quite a bit of inputs that go into the creation of this index. I would say around 60 or so inputs. before this line is generated. And for now, we're getting kind of close to significant improvement and possibly even a flip into the bullish mode. But for now, it hasn't happened yet, and I'm still considering today's picture as a bearish picture and looking only to short. I'm not looking to go long just yet. If when we do get a bullish breakout and a continuation higher, then I'll be looking for bullish opportunities. Alright, this is S&P 500 again, going back 3 years, and this is a weekly chart. So what I did is I put in a Fibonacci retracement from the high to the low here, and the high was incidentally last May, to the low here in February. And the Fibonacci retracement, the 50% retracement, falls around 1975. Now here on the left, these blue horizontal bars are what's called volume by price. So it shows the amount of volume traded at the particular level. And you can see that this bar around 1975 is sticking out more than the rest of the bars. So it coincides with the level of 50% retracement. Also, we had several bottoms here, and then a support break right there as well. So this area around 1975 seems to be of importance to S&P 500, going back about a little bit over a year. Now, again, so this if this is the top for this rally of the February lows, then this would be a logical place for a retracement, and we could retrace here and potentially bounce higher. Next chart shows the same exact chart, but what I did, this is only close only chart, and this actually speaks volumes about the trend that started back in last year in July, August. You can see that on closing basis, the closing basis high was here in July, August, and since then on closing basis we've been making a series of lower highs and lower lows, and on closing basis for S&P 500 without the dividends, we're yet to exceed the all-time high and make a higher high. So if we fail here, that would be a certainly a discernible lower high again. And if we pull back, we may actually pull all the way back to 1864 and close below it, and that could be the beginning of some kind of an Armageddon move, possibly down to the breakout level after 2009 bull market has begun. Now, again, hasn't happened yet. We could actually just continue higher, like I said. So we have to keep an open mind about all outcomes. Again, 50% retracement on closing basis falls a little bit higher, around 2000. And then, as I showed in the previous chart, so this area 1975 is certainly very important to S&P 500. All right, finishing up with S&P 500 in general. This is a seasonality chart of SPX, S&P 500, going back to 1997 to 2016. So what it does is shows percentage of month in which S&P 500 closed higher than it opened for this date period. So you can see that in April, generally speaking, S&P 500 closed higher than it opened on 75% of occasions, and the average gain was 2.1%. So that's over the past 20 years. May, you can see it closed higher than it opened 58% of the time, and the average gain was only 0.2%. And then further on, in, for example, June, August, and September, pretty much we usually had losses for those dates in the past. So this whole period from May until September is considered like a weak seasonality time period for S&P for stocks in general. And there's a famous saying on Wall Street: sell in May and go away, and that's probably wise because this is a weak period and lots of traders on vacation, so people just sell in May, go on vacation, come back around the end of September and start trading again, because you can see the October, November, December, they're usually strong months, and they're usually and higher than where they started. All right, this is TLT, the Treasury Bond Fund. Actually, surprisingly, TLT is quite volatile. If you look at the standard deviation of S&P 500 versus TLT, the TLT has higher standard deviation. So TLT is actually more volatile than S&P 500. But in any case, bonds are hit all-time highs here in February, corrected sideways, slightly down, and then attempted again. So far, they failed. So that's certainly a concern for bond bulls, and I'm one of those bond bulls. Also, we had a break below the 50-day moving average, and then followed by a gap the next day on Thursday. So far this gap has held, and this certainly is a concern, and we could potentially see further correction. So there is a breakout level here at 127. It touched the same level here in March, so it would make sense that we correct down to that level again. Now, I still think that this is a bullish chart, so I think that the correction down to around 127 may actually offer a nice entry opportunity. Here you can see we took opportunity back here, and actually it ran up to all-time highs after we entered around here. Moving on to AGG, this is a more diversified bond fund, and I actually prefer trading it more than TLT. It's just less volatile. You can see that it is at all-time highs, and this correction is really not that big of a deal, compared to TLT. So I think this is a bullish chart again. We could see some maybe sideways movement, but if S&P 500, if stocks come under selling pressure, most likely bonds will benefit. At the very least, they most likely won't drop. Now, I think some pretty interesting action happened in the currencies arena. So we had support. This is US dollar on daily time frame. So looks like we held support here twice in as many weeks. So we had a move down to 93, 94 area, and then again this week we kind of came down to this area and then really bounced right off of it. And this rally for the past 3 days actually was quite broad. You can see that dollar gained against euro and really gained against yen, strongly gained against yen. So we'll look at yen in the next slide. The pound strengthened, but the pound only accounts for smaller percentage of the US dollar index than the yen and the euro. The longer term chart, again, I still think that this could be a bullish cup and handle, and if we hold support here, rally up to the we'll have to first pass this resistance level, but if we break out above 100 here, this could be quite bullish for the dollar. So let's look separately at the yen and this drop here. Okay, so this is US dollar versus Japanese yen, and if you trade currencies, then you know that so for example, since the chart is moving down, that means that the Japanese yen is winning this struggle. So here we had quite a strong support level around 111, and then a break below it here in beginning of April. But now I'm looking at it, this could be a bear trap because as soon as we moved down below it, we immediately bounced above it, and especially Friday with the announcement of potentially more negative interest rates by the by the Bank of Japan. The yen really gave up quite a bit of its gains, lost 2% versus the dollar. So this is really quite an interesting chart, and this is actually 52-week lows or 52-week highs for the yen. So we'll see where this is going, but this could be a bear trap, and this could be a reversal in the yen versus the dollar. So of course, since the gold is priced in dollars, again, so it's gold divided by US dollar. If the dollar is gaining in value, gold should come under pressure, and you can see that the dollar has held support while gold. This could be like a nice rejection candle right here, and then followed up next day, which is Friday, by a close below the 50-day moving average. So we could easily correct down to 1190. This is a breakout level above this high here. If we don't hold support here, the next support level rather is at at the 200-day moving average. Another support level here at around 1113. If we don't hold it, we could potentially retest multi-year lows. But I think that gold and gold miners, of course, are currently in a new bull market, and this retest would be an important test to see if indeed gold is resilient to the profit taking, and if indeed we are in a new bull market for gold. Next chart shows GDX. This is another of my custom market breadth indicators, GBI, gold breadth index, and it attempts to show whether or not gold and by extension gold miners are in a bull or bear market. I think that gold has entered a new bull market here in mid-March. But in any case, this is quite an impressive move here. This is almost 100% move of the lows, and this is actually another bear trap right there. You can see a breakdown, but then it immediately rallied back up. So this is almost 100% move, and it's certainly overdue for a correction. Up here we have what's called an outside reversal. So this candlestick on Tuesday, and you can see that this Wednesday's candlestick is completely overshadowed, Tuesday's candlestick is completely engulfed by this Wednesday's candlestick. It's not a true bearish engulfing because the real body doesn't engulf the real body. But in any case, it's a very large amplitude candlestick. And Friday we see a confirmation of it. You see a confirmation by close below it on Friday. So we certainly could see profit taken and correction, well, at least to the 50-day moving average, possibly even lower to the $18 area. But I think a biggest support test would come, if it corrects back down to around $17, which is a breakout level. Briefly, this is West Texas Intermediate on a weekly time frame. So we bottomed out here in February together with the stock market, and everybody is so excited about this spurious correlation between oil and the stock market. I still think that oil and stock market correlate poorly if you look at some of the longer term charts, but nevertheless, right now correlations are high. Anyways, looks like this level around $44 or so is really important. You can see what several touches here back in last year, a breakdown below this level, a rally above it, and then breakdown below it for good. So we're back to the $44 area, and below here I put in several of the indicators. One is RSI. This is a weekly chart, keep in mind. So looks like we have a little bit of a bullish divergence, pretty large bullish divergence, because this is a weekly chart. You can see it made a lower low while the RSI made a higher low. The same goes for money flow index, which is a volume-based indicator, and here also on balance volume you can see it's trending higher. So potentially we could see maybe we can come back to around $50. So there's resistance here, even bigger resistance around $54, and just enormous resistance up here at $60 or so. Okay, this is natural gas on a daily time frame. This is actually quite interesting chart. So we bottomed out here in multi-year lows in March. Had a rally to the 50-day, really choppy consolidation here. Finally a breakout. Actually, it could have gone either way, because this choppy consolidation could have resolved in a breakdown. But in this case, it broke out above this level, and I pointed out this level several weeks ago as well, and continued higher this week. So on Friday we closed very close to the 200-day moving average, this green line, and to this resistance level. You can see also this really large volume resistance here. So certainly lots of resistance at $2.30. However, if natural gas manages to punch through this resistance level, up here at $2.50 is really a very important one. And I think that if natural gas manages to close above that level, we could contemplate a new bull market in natural gas. Here you can see the bearish divergence. It still continues in unbalanced volume, but there was the same thing in RSI. There was a bearish divergence, but looks like it did not work out and resolved to the upside. So RSI is now approaching bullish territory. You can see that it failed here at around 65 or so, but if it does manage to get overbought, then potentially this could mean a new bull market natural gas. In fact, if we look at the next chart, you can see here this is the level at $2.50 that I just pointed out. Again, very important level to natural gas, because we had several touches. A failed breakout here at $2.50. So there is quite a bit of activity at this level. And I think if it manages to close above it and then maybe even hold on a retest, we could see prices come up potentially run higher. Also several bullish divergences here as well. All right, that's it for this week's recap. Thanks for watching, and please stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just a psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube, StockTwits accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching and have another great trading week. Bye bye.